Hey everybody, Dan again, stocktrades.ca, back at you with another video. This is going to be our very first video coming back to the channel where we're going to be focusing on both US and Canadian ETFs. We're going to go over index funds, actively managed funds, niche funds, anything that I can think of to provide value to you, somebody who may not want to be buying and selling individual stocks, and instead you want to go the ETF route. In this video, I'm going to be going over a fund by Hamilton, a bit of a controversial fund manager over the last while here, primarily because of a lot of investors who are critical on their high-yielding, high-MER funds. But in this video, I'm going to be going over a little bit of a different fund. It's actually one that is pretty reasonable. It's just a Big Six bank ETF that uses a bit of leverage to amplify returns and increase the income that it pays out in the fund, and that is HCAL. They trade under the ticker HCAL, and it is the Hamilton Enhanced Banking ETF. So with that said, I'm going to turn the screen to the computer, and I'm going to do a in-depth review on this fund to figure out if the fees are worth it, if the returns are worth it, when it will perform best, when it will perform the worst, and a ton more. So let's get right into the video. So first things first, before we get started, remember to like this video, subscribe to the channel. We're going to be putting out weekly videos on these ETFs. You can catch me every Thursday on the Canadian Investor Podcast, where I am discussing earnings commentary with Simone. And if you want to get access to our stock research, our screening tools, our Discord, there is a link in the description below to sign up for Stock Trades Premium. You can join over 2,000 other people there that are using that platform to help grow their portfolios. So the Hamilton Enhanced Canadian Bank ETF, what I'm going to do is go over the fact sheet relatively quickly, because this is going to be probably the most in-depth area you can go to find out some details on the fund, and I'm going to clear up maybe a bit of confusion that exists in these fact sheets. So the highlights: it aims to give exposure to Canada's Big Six banks with modest 25% leverage to enhance growth potential and yields. So it pays a yield of 7.59% paid monthly, and it states that it has similar volatility to the Big Six Canadian banks. Now, you might be asking yourself how the Canadian Bank Index can pay 4.92% and HCAL can pay 7.59%. And that comes basically from the leverage of the fund. They're able to generate more returns holding that leverage, and as a result, they can pay out more as a distribution. Remember, this is a distribution and not a dividend, so it can make up a wide variety of things. It can be interest income, it can be foreign income, it can be capital gains, it can be eligible dividends, non-eligible dividends. So remember, these funds are paying a distribution, which is not necessarily purely a dividend. How it can do this, we'll get a bit more into the tax situation of HCAL, how it did in 2023, and how I'm going to show you that this distribution might not always be the best thing, especially when the banks struggle. So it says it has similar volatility to the Big Six banks. I would imagine this is a standard deviation. In fact, if we go down to the footnotes here, where can we find that? Volatility is the annualized standard deviation of daily returns. So the higher the standard deviation, the more volatile the returns. So it's not really surprising here to see Royal Bank, which is Canada's largest bank, have the lowest standard deviation out of all of the rest. But you can see that, relatively all the banks are the same, and this fund, despite utilizing leverage, does have similar volatility. So the investment objective of the fund is to track 1.25x returns of the selective equal weight Canadian banks index. So this is an index fund. It contains a equal weight position to all 6 Canadian banks. And what HCAL will do is pretty much try to mimic this fund, but with amplified returns and, as I'll discuss in a bit, amplified losses in the case of leverage. It does not use derivatives. This is just a pure cash leverage position in which it buys more of its underlying holding, which would be its own HEB, it pretty much tracks an equal weight portfolio of the big six banks. So we can see here HEB's exposure is 17.5% to CIBC on the top end of things and 15.2% to Bank of Nova Scotia on the bottom end. Now, depending on when you're watching this, this could be very different. This fun facts is updated as of January 31st, 2024. But just make sure if you're actually interested in the holdings to head to the website and actually look them up live in real time. So management fee 0.65%, but management fee does not equal MER. I cannot stress this enough. The management fee you pay is not the management expense ratio. And if we actually look to the document from Hamilton, which discusses everything about the fund, like the overall risks, what it's made up of, we can see here that the total management expense ratio is 1.46%. This means you are paying $14.60 for every $1,000 you have invested every year. So the one thing about this is the management expense ratio is also not the total ratio you're going to pay. You also have the trading expense ratio. So if we come down here, where am I going to find this? So the trading expense ratio is 0.03. It's pretty insignificant in the grand scheme of things, but the total ETF expenses you're going to face by owning this are around 1.49%. At the time of update of this sheet, it can fluctuate quite a bit. So this is from June 7th, 2023. When leverage gets more expensive, there is a chance that the fund will have to charge more to maintain that leverage, because most margin accounts, like you would see at your standard brokerage that you're operating with, your margin account, if you were to borrow from it, will often be a particular percentage over prime. Generally, the more you borrow, the lower it is relative to the prime rate. But at the time of filming this video, I can't imagine a retail investor, they'd probably be paying close to 9 to 10% to borrow on leverage, which is crazy different than what it was during the pandemic. Although June 7th, 2023, rates, they haven't gone crazy since then. So I would estimate that this is probably going to be the fee that you're going to be paying. But again, keep an eye on this. It is an expensive fund, and I'm going to go over in a bit whether or not the expense ratio is worth it for you to get that leveraged exposure over what you could just get yourself at your brokerage. Okay, so back to the fund sheet. You can see this fund started in October of 2020. A lot of these niche type funds are starting post-pandemic. I mean, with the influx of investors into the market. You know, covered call ETFs, leverage ETFs, 2x, 3x ETFs going both ways, inverse ETFs, they've all just exploded in popularity, which is exactly why I wanted to start making these videos, to give you some insights on some of these funds. So it pays the distribution out monthly, and this is just it's pretty much a passively managed index fund. It's going to replicate that banking index, the Selective Equal Weight Banking Index. So it has about just under 500 million, just under $500 million in assets under management, and its risk rating is medium to high. Clearly, this is a very concentrated ETF, six stocks, all in the financial sector, and it also has that leverage element added into it. So I would say this is a relatively high risk fund, and I know Canadians are obsessed with bank ETFs, but that does not change the fact that there's a lot of concentration risk, and there is that added leverage element, which during a drawdown will impact your returns much more than just holding a normal ETF. And it also works in the reverse, obviously. You'll earn more when banks are going up. So as mentioned, modest yield leverage of 25% increases dividend yield and growth potential. So what this fund is doing is it will try to maintain this yield, and in the event of a bull market, it's probably going to generate more capital gains and more dividends through that leverage exposure than just a normal fund like Zeb would. So during good times, you can probably expect to see higher eligible dividends in the distribution, and you can expect to see capital gains in the distribution. However, if we remember in 2023, it was very bad. Well, I wouldn't say very bad, but it wasn't a very good year for Canadian banks. So when we look to the overall distribution makeup, which is very important, we can see that in 2023, HCAL paid out a total of $1.52 and 4/10 of a distribution over the course of the year. 48.4 cents of that was eligible dividends, so less than 1/3 of the distribution, whereas $1.03 was return of capital, which is pretty much a distribution that is tax-free when you receive it, but it will overall reduce your cost base, which could result in a higher capital gain down the line. So generally, when a fund has a shortfall in terms of paying the distribution, they'll pay it out as a return of capital. And again, because of how much banks struggled in 2023, it likely wasn't able to keep up with this distribution payment. And as a result, it had to issue return of capital. So you'll see this with a lot of these funds when they struggle, and during good times, especially the leverage funds, you're probably going to see more capital gains. So the one thing we need to understand with HCAL is ultimately the underlying ETF it holds. So the total holdings of HCAL is simply HEB, which is Hamilton's Canadian Bank Equal Weight Bank Index. Now, in my opinion, this is the best equal weight banking fund you can buy in Canada. When we look to the other ones, like I believe Horizons have one, I believe BMO has one, but HEB has the lowest fees to get you exposure to the big six banks. Now, whether or not I would own an ETF like this, especially at a commission-free brokerage like Wealthsimple or something, where you can just buy the bank's tax or commission-free, I'm not really sure if you would pay the 0.19%, if it's worth it to pay the 0.19%. I mean, some people like it because they have a monthly distribution. The fund is balanced for you. It's equal weight. And they kind of find it might be worth that fee to them over not holding the big six banks altogether. So depending on whether or not you like that, that's going to be completely up to you. Before commission-free brokerages came around, I did actually like equal weight Canadian banking ETFs for those who wanted full exposure to the industry, because if you were to go on a trading platform and on something like, say, Qtrade, Questrade, stuff like that, if you wanted to buy all six of the banks, they would charge you a commission fee, which ultimately, if you started with a really tiny amount, it would eat into your fees quite a bit. So at that time, I kind of thought, it might be worth it for somebody to own a fund like that, because if they have a small starting amount where the commissions would eat away at a lot of their returns, they can just one-click buy Canada's big banks. But now that we got fractional shares, we got commission-free brokerages, I'm starting to doubt the use of these funds, but I cannot deny that HEB is it's the best one out there. So the fund's holdings, it's very simple. It's just like I showed you in HCAL. It's just the 6 ETFs. It has about $640 million in assets under management. It's one of the fastest growing funds out there for sure when it comes to equal weight banking ETFs, primarily because of that low fee. But what you need to know about HCAL is it is entirely HEB, and then it uses that cash leverage position to earn more. And the one thing I did recognize from this is this outperformance here, and I do want to show you something in the fact sheet of HCAL. So when you come into this fact sheet, you come down to the return chart here. This is not a return chart of HCAL. I can't stress that enough. It has not existed this long. What they're doing here is they're showing you the benefits of moderate leverage since 2007. So this is nothing more than a back test going back to 2007 to show you how the leverage element would cause you to outperform. Now, this is not all that surprising. Canadian banks post-financial crisis did very, very well. They had a huge run-up, and we can start to see in 2014 an actual leverage position would definitely start to separate itself from simply owning the index. But again, I can't stress enough, these returns ultimately mean nothing. What leverage did in the past doesn't mean it'll do so in the future. What Canadian banks did in the past certainly does not mean they're going to do it in the future. So just don't get too caught up on these historical returns. You need to be thinking from a forward basis. So how has HCAL performed? If we go to this chart, it's not hard to see when this fund is going to perform well and when it's not. So it started in 2020. It caught the big big run up by the Canadian banks, where they had a very, very good 2021. And as a result, if we look until, early 2022, this fund had outperformed a standard bank ETF by about 20% through the, first couple of years of its performance. However, in 2022, when they started raising policy rates and when the banks really started to struggle, we can see that the fund pretty much gave all of it back. By the end of the year or midway through the year, the fund was, pretty much equal performance with, a standard bank ETF. Now, it would go through particular situations where it would outperform, where it would underperform, but overall, when we sit, what would it be, almost 3 years later, it hasn't really performed any better than a just regular run-of-the-mill bank fund, like a bank fund holding the top 6 banks. However, what I would say is it's done so during a pretty harsh time for Canadian banks. So it does make sense to an extent if you're comfortable with leverage and you're pretty bullish on Canadian banks. If you're comfortable with that leverage, it could work out to be, as you can see in 2021, it probably will work out to be better because of that leverage exposure. It's going to get you higher returns during times like this. So the one question that a lot of people have is this high fee worth it in regards to having Hamilton utilize the leverage or having you utilize the leverage yourself via a margin account or something? Again, if you're comfortable with that leverage. And if we run the basic math, on $100,000 invested, this fund is going to cost you, let's just round it up to $1,500 a year on $100,000 invested. So I went here to Qtrade. So let's say you were going to invest $100,000 yourself into Canada's big 6 banks, and you were going to utilize $25,000 in leverage to get to that 1.25x. I'm just using a website like Qtrade for margin rates. There's probably better margin rates out there, but this is strictly an example. So if you borrow that much, you're going to pay prime plus 1.55%. So you're looking at a 7.2% prime rate. So if we add that together, you're going to pay about 8.75% annually on that $25,000 to own the fund. Now, if we take 8.75% of 25,000, you're going to get to a total of just under $2,200 you'll pay to hold that margin balance every year. So when you look to the immediate savings of somebody who, again, is comfortable with this leverage, wants to deploy this strategy anyways, this fund is actually not outrageous because you're getting cheaper access to that leverage than you would actually doing it yourself. In addition to this, you don't have to rebalance your holdings. They do it all for you. They make the transactions. They pay you the distribution. So overall, it's not that bad of a fund. I know Hamilton takes, a lot of heat, again, for their high-yielding funds that provide unsustainable distributions. This one is very easy to understand how it gets to that distribution. It's the leverage position. We can see last year the bank struggled, so in order to keep up with that distribution, it had to pay out that return of capital. But generally, if the banks are in a bull market, this fund should be able to perform pretty well. Now, should you buy it? That is absolutely, completely up to you. If you want to utilize that leverage, if you're pretty bullish on Canadian banks and you want to get that extra performance during a bull market, then this provides you really, really easy accessibility to that leverage. I mean, it's kind of a pain on a personal level. As I mentioned, you have to rebalance the account. You actually have to take the leverage out yourself. You could be margin called. Anything can happen. Whereas with a fund like HCAL, you buy the thing, you get the leverage. If you're comfortable with the risks and rewards, you understand how the fund works, and I'm kind of hoping I helped you in this regard, then it seems like a fairly reasonable fund. It's high fee, but it's high fee because of the leverage that it's taking on. So, I mean, that's pretty much it. for the video on this fund. It contains HEB, which is their equal weight bank index, and now it takes a cash leverage position to buy more of it. In turn, they boost the distribution to provide more income to those who want it. Again, overall, it shouldn't be that relevant. You should just be looking for total return. I can't stress this enough. But during the good times, this fund will outperform a standard bank ETF because they both follow an index. So all else equal, you have two funds following an index. During a bull market, the one with leverage is going to outperform the one without. However, on the downside, when the funds struggle, when Canadian banks struggle, you're going to lose more in that leverage position. And as a result, you need more potential earnings to equal that out. Again, it's the kind of the simple concept where if you lose 50% on a position, you don't need 50% to get it back. You need 100% to get it back. So on the downside, leverage provides a bit more of an impact than it does to the upside. But overall, I think it's a pretty interesting fund when it comes to just a leveraged bank ETF. If you like the banks and you're comfortable with the added risk of leverage, it seems like a pretty reasonable fund if you want to add it to your portfolio today. Ultimately, I can't make that decision for you. You have to decide whether or not you're comfortable with that risk profile, the concentrated fund in terms of Canadian financials with the leverage. But overall, I hope you like this first video. Hopefully I didn't ramble on too much, but I love diving into these funds in depth and providing some solid analysis so that people can decide whether or not it's right for them. So again, everybody, head down below, smash that subscribe button, like the video, share the video, comment down below what fund you want me to look into next, and I will dive right into it. And again, Thursdays, I'm on the Canadian Investor Podcast. We're talking stock earnings, all that type of stuff. Stock Trades Premium. If you want to join up there, I'll drop a link below in the description with a discount. You'll get access to our Discord, all our research reports, our trading tools, our Q&A. You can see my portfolio in its entirety, all the transactions I'm making, things like that. And we'll see you next time.